Let's take a look at understanding a balance sheet. Financial statements are the periodic report cards of how a business is doing from a monetary perspective. After all, money is the primary way in which a score is kept in the competitive arena of business. These important statements are a summary of a company's financial data compiled from business activity over a period of time. Typically, a company's accounting department prepares financial statements quarterly for the purpose of management review and government reporting of income tax information. At the end of the year, the accounting department prepares annual financial statements to present to the company's yearly financial position and their performance. Financial analysis is the assessment of a company's past, present, and anticipated future financial condition based on information found on the financial statements. Financial ratios are the primary tool of this analysis. These ratios are a way of standardizing financial data so that they can be compared with ratios from previous operating periods of the same firm or from other similar-sized firms in the same industry. Internally, owners and managers rely on this analysis to evaluate a company's financial strengths and weaknesses and help make sound business decisions. From outside the firm, creditors and investors use financial statements and ratios to determine a company's creditworthiness or investment potential. The balance sheet is the financial statement that lists the company's financial position on a certain date, usually at the end of a month, a quarter, or a year. To fully understand the balance sheet, we must first examine some basic accounting theory. Financial position refers to the economic resources owned by a company and the claims against those resources at a specific point in time. Equities is another term for claims. Keep in mind that a firm's economic resources must be equal to its equities. A business enterprise can therefore be pictured as an equation: economic resources equal equities. There are two types of equities: the rights of the creditors, those who are owed money by the business, and the rights of the owners. The rights of the creditors are known as liabilities and represent debts of the business. The rights of the owners are known as owner's equity. Owner's equity represents the resources invested in the business by the owners. Theoretically, owner's equity is what would be left over after all liabilities were paid to creditors. We can now enhance our equation: economic resources equals liabilities plus owner's equity. In accounting terminology, the economic resources owned by a business are known as assets. The equation now becomes assets equals liabilities plus owner's equity. This all-important equation is known as the accounting equation. The balance sheet is the visual presentation of this equation at one point in time. Some balance sheets display the assets on the left and the liabilities and owner's equity on the right. Another popular format lists the assets on the top and the liabilities and owner's equity below. Remember, on a balance sheet, the assets must be equal to the liabilities plus owner's equity. The balance sheet is the financial statement that lists a company's financial position on a certain date, usually at the end of the month, a quarter, or a year. To fully understand the balance sheet, we must first examine some basic accounting theory. The assets section of the balance sheet is divided into three components: current assets, property, plant, and equipment, and investments and other assets. Current assets are cash or assets that will be sold, used, or converted to cash within 1 year. Property, plant, and equipment are also known as fixed or long-term assets. These assets will be used by the firm in operation of the business for a period of time longer than a year. Investments and other assets is a category that lists the firm's investments and all other assets. The liability and owner's equity section of the balance sheet lists the current and long-term liabilities incurred by the company, as well as the owner's net worth or claim against the assets of the business. From the accounting equation, it is the difference between the total assets and the total liabilities. Current liabilities and debts are financial obligations of the company that are due to be paid within 1 year. Long-term liabilities are debts and financial obligations of the company that are due to be paid in 1 year or more, or are to be paid out of non-current assets. When a business is organized as a sole proprietorship or partnership, the equity section of the balance sheet is known as owner's equity. The ownership is labeled with the name of the owners or business and the word capital. When the business is a corporation, the equity section of the balance sheet is known as stockholders' equity. The ownership is represented in two categories: capital stock and retained earnings. Don't be overwhelmed by the amount of new terminology associated with financial statements. Start by understanding the function and basic structure of each statement. Then, learn the purpose of each major category. This should help you determine in which category of the statement each component is listed. Vertical analysis is a percentage method of analyzing financial statements whereby each item on the statement is expressed as a percent of a base amount. On a balance sheet analysis, the base is the total assets. On income statements analysis, the base is net sales. In vertical analysis, each item of the balance sheet is expressed as a percent of total assets, where total assets equal 100%. Once the vertical analysis has been completed, the figures show the relationship of each item on the balance sheet to total assets. For analysis purposes, these percents can then be compared with previous statements of the same company, with competitors' figures, or with published industry averages for similar-sized companies. A special form of the balance sheet known as a common-size balance sheet is frequently used in financial analysis. Common-size balance sheets list only the vertical analysis percentages, not dollar figures. Here are the steps to prepare a vertical analysis of a balance sheet. Step 1. Use the percentage formula to find the percentage of each item on the balance sheet. Use each item as the portion and total assets as the base. Step 2. Round each answer to the nearest tenth of a percent. Step 3. List the percent of each balance sheet item in a column on the right of the monetary amount. In vertical analysis, remember that each item on the balance sheet is the portion and the total assets is the base. Because of rounding, the percents may not always add up to 100%. This type of presentation is known as a comparative balance sheet because the data from different periods can be readily compared. This information provides managers, creditors, and investors with important data concerning the progress of the company over a period of time, financial trends that may be developing, and the likelihood of future success. Comparative balance sheets use horizontal analysis to measure the increases and decreases that have taken place in the financial data between two operating periods. In horizontal analysis, each item of the current period is compared in dollars and percent with the corresponding item from the previous period. Here are the steps to preparing a horizontal analysis. Step 1. Set up a comparative balance sheet format with the current period listed first and the previous period listed next. Step 2. Label the next two columns amount and percent. Step 3. For each item on the balance sheet, calculate the dollar difference between the current and previous periods and enter this figure in the amount column. Step 4. Calculate the percent change, increase or decrease, using the percentage formula. Percent change or rate is the amount of change, the step 3 portion, over the previous period amount, the base. And then step 5. Enter the percent change, rounded to the nearest tenth of a percent, in the percent column. An income statement, also known as an operating statement or profit and loss statement, is a summary of the operations of a business over a period of time, usually a month, a quarter, or a year. For any business to exist, it must have earnings as well as expenses in the form of either cash or credit. The income statement shows the revenue or earnings of the business from the sale of goods or services, the expenses, the cost incurred to generate that revenue, and the bottom line profit or loss, the difference between revenue and expenses. So profit or loss equals revenue minus total expenses, where revenue equals earnings, either cash or credit, from sales during the period of time, and total expenses equals the cost of goods sold plus operating expenses plus taxes. Keep in mind that an income statement covers a period of time, whereas a balance sheet covers a moment in time. An income statement, also known as an operating statement or profit and loss statement, is a summary of the operations of a business over a period of time, usually a month, a quarter, or a year. The revenue section of the income statement represents the primary source of money, both cash and credit, flowing into the business from its customers for goods sold or services rendered. Gross sales are the total sales of goods and services achieved by the company during the operating period. Sales returns and allowances is the amount of merchandise returned for cash or credit by customers for various reasons. Sales discounts are cash discounts given to customers by the business as an incentive for early payment of an invoice. For example, 315N45, where 3% extra discount is given if the invoice is paid within 15 days rather than the net date of 45 days. Net sales is the amount received after taking into consideration returned goods, allowances, and sales discounts. Merchandise inventory, beginning of operating period, is the total value of the goods in inventory at the beginning of the operating period. This beginning inventory is the last period's ending inventory. Net purchases are the amount at cost of merchandise purchased during the period for resale to customers after purchase returns and allowances and purchase discounts are earned and deducted. Freight is the total amount of the freight or transportation charges incurred for the net purchases. Goods available for sale is the total amount of goods available to be sold during the operating period. It's the sum of the beginning inventory, net purchases, and freight in. Merchandise inventory, end of the operating period, is the total value of the goods remaining in inventory at the end of the operating period. This ending inventory is the next period's beginning inventory. Cost of goods sold is the total value of the goods that were sold during the period. It's the difference between goods available for sale and the ending merchandise inventory. Gross margin, also known as gross profit, represents the difference between net sales and the cost of goods sold. Total operating expenses are the sum of all expenses incurred by the business during the operating period except the cost of goods sold and taxes. Operating expenses differ from company to company. Some typical examples are salaries and benefits, sales commissions, rent and utilities, advertising and promotion, insurance, general and administrative expenses, depreciation, and miscellaneous expenses. Income before taxes represents the money a company made before paying income tax. It's the difference between gross margin and total operating expenses. Income tax is the amount of income tax, both state and federal, that is paid by the business during the operating period. Net income, net profit, or net loss is the bottom line of the income statement. It's the difference between income before taxes and the income tax paid. Keep in mind that an income statement covers a period of time, whereas a balance sheet covers a moment in time. Vertical analysis is a percentage method of analyzing financial statements whereby each item on the statement is expressed as a percent of a base amount. On a balance sheet analysis, the base is total assets. On an income statement analysis, the base is net sales. Each figure on the income statement is expressed as a percent of net sales equaling 100%. The resulting figures describe how net sales were distributed among the expenses and what percent was left as net profit. For analysis purposes, this information can be compared with the figures from previous operating periods for the company, with the company's competitors, or with published industry averages for similar-sized companies. As with balance sheets, income statements with vertical analysis can be displayed in a format known as common size, in which all figures on the statement appear as percentages. Here are the steps to preparing a vertical analysis. Step 1. Use the percentage formula to find the rate of each item on the income statement. Use each item as the portion and net sales as the base. Step 2. Round each answer to the nearest tenth of a percent. Step 3. List the percentage of each statement item in a column to the right of the monetary amount. This horizontal analysis provides percent increase or decrease information for each item of the income statement. Such information provides a useful progress report for a company. As before, the previous or original period figure is the base. Here are the steps for preparing a horizontal analysis. Step 1. Set up a comparative income statement format with the current period listed first and the previous period listed next. Step 2. Label the next two columns amount and percent. Step 3. For each item on the income statement, calculate the dollar difference between the current and the previous period and enter this figure in the amount column. Step 4. Calculate the percent change, increase or decrease, by the percentage formula, where percent change, the rate, equals the amount of change in Step 3, the portion, over previous period amount, the base. Finally, Step 5. Enter the percent change rounded to the nearest tenth of a percent in the percent column. This horizontal analysis provides percent increase or decrease information for each item of the income statement. Such information provides a useful progress report for a company. As before, the previous or original period figure is the base. Here are the steps for preparing a horizontal analysis. Step 1. Set up a comparative income statement format with the current period listed first and the previous period listed next. Step 2. Label the next two columns amount and percent. Step 3. For each item on the income statement, calculate the dollar difference between the current and the previous period and enter this figure in the amount column. Step 4. Calculate the percent change, increase or decrease, by the percentage formula, where percent change, the rate, equals the amount of change in Step 3, the portion, over previous period amount, the base. Finally, Step 5. Enter the percent change rounded to the nearest tenth of a percent in the percent column. Liquidity ratios tell how well a company can pay off its short-term debts and meet unexpected needs for cash. A ratio is a comparison of one amount to another. A financial ratio is simply a ratio whose numerator and denominator are financial information taken from the balance sheet, the income statement, or other important business data. Businesses must have enough cash on hand to pay their bills that are currently due. The liquidity ratios examine the relationship between a firm's current assets and its maturing obligations. The amount of a firm's working capital and these ratios are good indicators of a firm's ability to pay its bills over the next few months. Short-term creditors pay particular attention to these figures. The term working capital refers to the difference between current assets and current liabilities at a point in time, where working capital equals current assets minus current liabilities. Theoretically, it's the amount of money that would be left over if all current liabilities were paid off by current assets. Current ratio, or working capital ratio, is the comparison of a firm's current assets to current liabilities, so current ratio equals current assets over current liabilities. This ratio indicates the amount of current assets available to pay off $1 of current debt. The current ratio of 2 to 1 or greater is considered by banks and other lending institutions to be an acceptable ratio. Finally, the acid test or quick ratio indicates a firm's ability to quickly liquidate assets to pay off current debt. So quick assets equal cash plus marketable securities plus receivables. So our acid test ratio equals the quick ratio over current liabilities. This ratio recognizes that a firm's inventories are one of the least liquid current assets. Merchandise inventories and prepaid expenses are not part of quick assets because they're not readily convertible to cash. An acid test ratio of 1 to 1 or greater is considered acceptable. Efficiency ratios indicate how effectively a company uses its resources to generate sales. Efficiency ratios provide the basis for determining how effectively the firm is in using its resources to generate sales. A firm with $500,000 in assets producing $1 million in sales is using its resources more effectively or efficiently than a firm producing the same sales with $2 million invested in assets. Average collection period indicates how quickly a firm's credit accounts are being collected. The average collection period equals accounts receivables times 365 over credit sales. Note, when credit sales figures are not available, net sales may be used instead. Inventory turnover is the number of times an operating period that an average inventory was sold. So average inventory equals beginning inventory plus ending inventory over 2, where inventory turnover equals cost of goods sold over average inventory. Asset turnover ratio tells the number of dollars in sales the firm generates from each dollars it has invested in assets, where assets turnover ratio equals net sales over total assets. This ratio is an important measure of a company's efficiency in managing its assets. Leverage ratios show how and to what degree a company has financed its assets. When firms borrow money to finance assets, they're using financial leverage. Investors and creditors alike are particularly interested in the leverage ratios because the greater the leverage a firm has used, the greater risk of default on interest and principal payments. Such situations could lead the firm into eventual bankruptcy. Debt-to-asset ratio measures to what degree the assets of the firm have been financed with borrowed funds or leveraged. This ratio identifies the claim on assets by the creditor. It is commonly expressed as a percent, where debt-to-assets ratio equals total liabilities over total assets. Debt-to-equity ratio is used as a safety factor measure for potential creditors. The ratio compares the total debt of the firm with the owner's equity. It tells the amount of debt incurred by the company for each dollar of equity. It's commonly expressed as a percent, where debt-to-equity ratio equals total liabilities over owner's equity. Profitability ratios tell us how much of each dollar of sales, assets, and stockholders' investment resulted in bottom-line net profit. The profitability ratios are important to anyone whose economic interests are tied in the long-range success of the firm. Investors expect a return on their investment in the form of dividends and stock price appreciation. Without adequate profits, firms quickly fall out of favor with current and future investors. Gross profit margin is the assessment of how well the cost of goods sold category of expenses was controlled. In particular, this measure spotlights a firm's management of its purchasing and pricing functions. Gross profit margin is expressed as a percent of net sales, where gross profit margin equals gross profit over net sales. Net profit margin is an assessment of management's overall ability to control the cost of goods sold and the operating expenses of the firm. This ratio is the bottom line score of a firm's profitability and is one of the most important and most frequently used ratios. Net profit margin can be calculated either before or after income tax. As with gross profit margin, it's expressed as a percent, where net profit margin equals net income over net sales. Return on investment is the amount of profit generated by the firm in relation to the amount invested by the owners. Abbreviated ROI, this ratio is commonly expressed as a percent, where return on investment equals net income over owner's equity. Trend analysis is the use of index numbers to calculate percent changes of a company's financial data for several successive operating periods. Trend analysis introduces the element of time into financial analysis. Whereas data from one statement gives us the firm's financial position at a given point in time, trend analysis provides a dynamic picture of the firm by showing its financial direction over a period of time. Index numbers are used in trend analysis to show the percent change in various financial statement items. With index numbers, a base year is chosen and is equal to 100%. All other years' figures are measured as a percentage of the base year. Once again, we encounter the now familiar percentage formula, rate equals portion divided by base. The index number should be expressed as a percent rounded to the nearest tenth, where index number, the rate, equals the yearly amount, portion, over the base year amount, base. For example, if a company had $50,000 in sales in the base year and a $60,000 in the index year, the index number would be 1.2 or 120%. Here are the steps in preparing a trend analysis. Step 1. Choose a base year and let it equal 100%. Step 2. Calculate the index number for each succeeding year, where index number equals yearly amount over the base year amount. Step 3. Round each index number to the nearest tenth of a percent. From the following data, prepare a 5-year trend analysis of net sales, net income, and total assets. Step 1. The earliest year, 2011, would be the base year or 100%. The first calculation, 2012 net sales, index number is 2012 net sales index number equals 855,690 over 825,100, which equals 1.037 or 103.7%. Here's the 5-year trend analysis of net sales, net income, and total assets in percentage using those steps.